So hello class, this is exercise 2 on deferred taxes and how to complete it. So just like exercise 1, we're going to start with income before taxes, which was given. We're going to subtract our municipal bond interest, which was not as high as last year, but still needs to be subtracted. And then we introduced a second permanent difference, and that is payment for life insurance. These are costs, expenses on our income statement that are not deductible on our tax return because life insurance is not deductible, or the premiums at least. And so we're going to add that. So we subtracted the municipal bond interest just like we did last time. We add the life insurance. We are at $296,700. Then we can look at our temporary differences. So the first one we're going to consider is bad debts again, just like last year. But this year we're going to actually create the allowance to make sure that it's clear in our mind how this is working. This is what the allowance account would look like. $8,500 from the year before. We had write-offs of $19,050, and we know that our ending balance needs to be 3% of the $840,000. So that is $25,200. There's only one credit that would make this T account work, and that's $35,750. That must be our credit to the allowance and our debit to bad debt expense. So just like last year, the amount of difference between the write-offs and the estimate between these two numbers in our T account is going to go here as an addition to our income on the tax return, because we can't deduct as much. We can only deduct this much on the tax return, and we recorded this much on the income statement. However, later when we're considering this deferred tax asset, our cumulative difference between tax and our income statement is right here in the allowance, the ending balance of $25,200. So we'll come back to that. We introduced a new temporary difference, unearned revenue. Under tax law, as soon as you get that money, you have taxable income, even though under GAAP you must defer it until you actually earn it. So the whole $11,000, since this is a new temporary difference, it doesn't exist before, we don't have to look at past years or anything, it's just $11,000 difference. And that's going to be added to our taxable income because we can't deduct that. So that's a future deductible amount, just like bad debt. So both of these are going to result in deferred tax assets. So the next thing we want to do is we have a new piece of equipment, and we have the old equipment, or not that old, purchased the year before. So we need to calculate depreciation on both of those assets for our tax return and on our income statement. So let's first do a little bit backwards and do this 2016 equipment first. For our income statement, or our book depreciation, we're just going to take 7185 divided by 5 divided by 2 for half a year convention and get 719 depreciation on the income statement. For tax purposes, we're going to depreciate the whole thing. There is a rule, section 179 of the Internal Revenue Code, that allows for certain assets to be depreciated for the whole amount in year one. So we're going to go ahead and take advantage of that. All right, so the difference between those two for the year is $64.67, with the higher amount being on the tax return. So we're going to subtract that extra $64.67 on the tax return over here for 2016 equipment. Now, perhaps a little more complicated is the 2015 equipment. Now we're in the second year depreciation. So for year 2, to calculate the depreciation on that 2015 asset, we're going to simply take the 61,500 original cost divided by 7, but you don't divide by 2 this time because there's no half year, because this is the second year we owned it. So that would be 8786. For makers or tax depreciation, we take the 30,750, just like we did last year after we took off the bonus. And we take that 30,750 and we multiply it by the maker's factor. And that could be looked up look up maker's depreciation table, and it will tell you what the second year of depreciation is supposed to be calculated at. And the number is 0.2449. We multiply that by the 30,750. We get 7531. And the difference between those two, between tax and book, is $1,255. But this year, the income statement depreciation is actually higher than the tax. So instead of subtracting additional depreciation, we're actually going to add, because our tax is actually lower. So we have to get rid of some of that depreciation. We're going to add that to our taxable income. So our taxable income is $319,189. Just like before, we're going to now make our journal entry for tax expense and tax payable by simply taking the $319,189, multiplying it by the tax rate. Now, as we consider our various tax assets and tax liabilities, let's consider first the allowance for bad debts. Our cumulative difference, and that's the one we want to refer to, is 25,200. That's our allowance. Multiply that by the tax rate, it's 8820. We then need a deferred tax asset of 8820. Last year, we created a deferred tax asset of 2975. So we take 8820 and we subtract the 2975 and we get our increase in the deferred tax asset, which is also a credit to the tax expense. So we debit tax asset and credit tax expense. Now for our new tax asset or future deductible amount or unearned revenue, we simply multiply it by the tax rate. Because there is no existing deferred tax asset, you can make the debit for the full $38.50 credit tax expense. So both of those are an increase to the tax asset and a decrease to tax expense. Now on the depreciation side, we're going to look at our cumulative depreciation. So after 2 years on the income statement, we depreciate $13,179 on the 215 equipment. That's the 43 or so from last year and the 87 from this year. And then on the tax side, it's the 35 from last year plus the 7 from this year added together. Then take the difference between the accumulated and the accumulated, 29,496, and we already did the 2016 because the difference for 1 year is the same as the accumulated because we've only owned it for 1 year, so it's 6467. Add those two together, get almost $36,000 difference. Multiply that by the tax rate. So the cumulative difference between the depreciation multiplied by the tax rate, 12,587, gives us our tax liability, what it should be. Compare that to our tax liability from last year, which was 10,763, and the difference is 1824. We want to make our tax liability go up from the 10 to the 12 by 1824. The debit is going to be tax expense. Total tax expense then, between all of those journal entries, all of the debits and credits to tax expense, gets us 103,845. Net income is then 204,155. We subtract the tax expense. And then we have an effective tax rate, just like we did before, of 3372. That's our 103,845 divided by the 308. It's different than the 35%, which we would have had tax expense of 107,800. The reason why is municipal interest caused the difference of 5425 and or 1.7%, 76%, and life insurance 0.48% the other direction. So we had two differences this year because two permanent differences. Last year was just one.